What funding options exist for buying out exiting family business members? When a family member decides to leave a family business, figuring out how to buy their ownership shares can feel like solving a tricky puzzle. There are several ways to make this happen smoothly. One simple option is for the buyer to use their own savings or personal funds. If they have enough cash saved up, they can pay the exiting member directly. But this isn't always possible if their savings are limited. Another common method is seller financing. This means the exiting family member agrees to receive payments over time instead of one big sum. The buyer makes regular payments, often from future profits or distributions from the business. This approach helps the buyer manage cash flow and can make the deal more affordable. It also spreads out the tax burden for the seller over several years. Bank loans are also a popular choice. The buyer or the business can borrow money from a bank or a financial institution to fund the buyout. Sometimes, the business might borrow a small part of the total cost, like 10 to 15%, to cover part of the purchase. The rest can come from seller financing or other sources. Taking out a loan does increase financial risk, but it provides the necessary cash upfront. In some cases, the business itself can buy back shares through a stock redemption agreement. This means the business repurchases shares from the exiting member gradually. It often involves periodic payments and requires the business to have enough cash flow. This method can help increase ownership for remaining family members over time. Trusts and family limited partnerships are more complex options but can be very useful. These structures help protect assets, reduce estate taxes, and enable gradual ownership transfers. They are especially helpful if the family wants to control how shares are transferred and manage tax implications. Gifting shares is another tool, though it doesn't provide cash. Family members can gift shares to others to reduce the ownership of the exiting member. This can help with estate planning but might trigger gift taxes. It's often used alongside other funding methods. Many families combine these options to create a flexible plan. For example, they might use a loan for part of the buyout, seller financing for the rest, and gift some shares to other family members. This mix helps balance the financial needs of everyone involved. When planning a buyout, it's important to get a fair market value for the shares. Also, consider tax effects like capital gains or gift taxes. Clear agreements and professional advice are key to making the process smooth and fair. This way, the ownership transfer can happen without disrupting the family's harmony or the business's future.